Hey everyone, and welcome back to the channel. Today we are going to list the best index funds for long-term investors. Let's get right into it. Number 1. Fidelity Zero Large Cap Index Fund. Investing in the S&P 500 index funds is perhaps the most certain way to build wealth over time. The Fidelity Zero Large Cap Index Fund, which tracks an index of just over 500 large cap stocks in the United States, outperforms an S&P 500 index fund. However, because it is not an official S&P 500 index fund, it avoids paying costly licensing fees to S&P Global, the index's parent company. The fund's benchmark is the Fidelity US Large Cap Index. The zero in the fund's name denotes that the expense ratio for this fund is 0%. There's also no minimum investment amount, making the fund a good choice for beginning investors. The fund moves in near lockstep with the S&P 500. Total returns since its inception in September 2018 were 43.4% as of mid-May 2022, just shy of the S&P 500's return of 44.2% during the same period. In early 2022, the fund was down about 18%, slightly more than the S&P 500. Number 2. Schwab S&P 500 Index Fund. If you want to invest in an official S&P 500 index fund, the Schwab S&P 500 Index Fund is one of the most affordable options. Its expense ratio is 0.02%, which means you'd only pay $0.2 per year for every $1,000 invested. Because of the low investment fee, your returns are nearly identical to the performance of the S&P 500. The fund's year-to-date total returns of 31.43% in 2021 were nearly identical to the S&P 500's. By May 2022, both the fund and the S&P 500 have fallen roughly 16% year-to-date. You can begin investing with as little as $1 because there is no minimum investment amount. Number 3. Vanguard Growth ETF. If you want to take on more investment risk in exchange for higher returns, the Vanguard Growth ETF is a good option. The fund replicates the CRSP US Large Cap Growth Index, which outperforms the S&P 500 Growth Index. This ETF invests in 266 large cap growth stocks in the United States. Technology stocks account for 49.7% of the fund's holdings, followed by consumer discretionary stocks and industrial stocks. Energy and utility stocks account for only 0.9% of the fund's value. This ETF has an extremely low expense ratio of 0.04%. As of December 31st, 2021, the fund's average annual return before taxes was 24.78%, easily outperforming the S&P 500 over the same time period. However, as tech stock continues to fall in 2022, the fund was down around 28% through May, significantly more than the S&P 500. Still, investing in Vanguard's growth ETF could present an opportunity to buy the dip. Number 4. SPDR S&P Dividend ETF. A top index fund for income-oriented investors is the SPDR S&P Dividend ETF. The benchmark for the dividend-weighted fund is the S&P High Yield Dividend Aristocrats Index, which tracks 119 of the S&P Composite 1,500 index stocks with the highest dividend yields. This ETF's holdings have all increased their dividend payments annually for at least the past 25 years. Dividend-paying stocks are less volatile than the overall stock market, so it's not surprising that the SPDR S&P 500 Dividend ETF was down slightly more than 3% to date through May, significantly less than the S&P 500. Dividend-paying stocks tend to be less volatile compared to the overall stock market, so it isn't surprising that the SPDR S&P 500 Dividend ETF was down just over 3% for the year through May, significantly less than the S&P 500. The fund's 12-month dividend yield as of May 2022 was 2.71%, well above the S&P 500's 1.46%. The expense ratio is also somewhat higher at 0.35%. The fund's top 5 holdings are Manufacturing Corporation, Leggett & Platt Inc., IBM, Global Packaging Company, Amcor plc, ExxonMobil, and National Retail Properties, a real estate investment trust, or REITs. The fund includes several REITs, which typically pay high dividends because they must distribute at least 90% of their taxable income. The ETF is underweight in technology stocks, which do not typically pay out large dividends. Number 5. Vanguard Real Estate ETF. If you want to invest in real estate across the board, the Vanguard Real Estate ETF is a good low-cost option. With an expense ratio of 0.12%, it's also by far the largest real estate index fund, with about $86.3 billion of assets under management. The MSCI US Investable Market Real Estate 2550 Index serves as its benchmark, broadly tracking the US real estate market. Although the index includes a few real estate management and development firms, it is primarily equity REITs, which own and operate income-producing real estate. The ETF is appealing to dividend investors because it invests primarily in REITs. The fund's 12-month dividend yield was 2.45% as of May 2022. Because real estate has traditionally been viewed as an inflation hedge, the Vanguard ETF may also appeal to investors concerned about inflation. Because 2022 has been a difficult year for stocks, many of the funds we mentioned have fallen this year. But keep in mind that index investing is about building wealth over time. Don't let short-term volatility keep you from starting. That's it for today. If you guys enjoyed the video, make sure to hit that like button. Don't forget to subscribe and turn on that notification bell so you never miss out on any future content we'll produce for you guys. We're signing off now, but we'll be sure to catch you all in the next one.